Good evening, everyone. Welcome to the investor presentation of Ador Welding Limited. We'll start the investor meet by a small presentation by our MD, sir, and then we'll take your questions.
Good afternoon. I hope you all can hear me clearly. Just wanted to give a very quick introductory presentation, and then we can go into the question and answer section. We had our board meeting on Thursday, Tuesday, 30th April, which means Thursday. This is a quick overview of the business, which is all available in results. The welding business contributed approximately 678 domestically. From the flares, it was approximately 35 crores, 172 of the equipment and automation space, and another 678 from the consumable space towards 1824. Segment-wise margins, which are all reported in the results itself, the consumable margins improved a slight amount. The equipment margins dipped a bit on account of certain automation hits, which are getting turned around over the course of this year. And the flare and process equipment, of course, which you know has taken a hit on account of slightly later than expected execution of the project. PBT and ROC figures have, due to certain segments having a slightly tough Q4, have taken a hit, especially from the flares and process equipment division, which is why the overall margins dipped down over in FY24 compared to what we were expecting. And the ROC level remains fairly in line with where we were last year. Working capital borrowings, especially if you look at the welding business alone, have done quite well. Most of that is in line with our expectations, and with the way the business is moving at the moment should remain as such. The focus areas leading into this year and a lot of what has got spilled over from the previous year as follows. We're going to keep on pushing more towards high-end welding equipments also. That would also have a Make in India tag to it and allow us to give a wider range of offerings to our clientele. The plasma cutting space is something that's very critical to us as part of our growth plans. And we'll definitely be driving that, and hopefully over the next 6-8 months, make a larger leapfrog with that. The project execution is critical to us, which has been there for the last 2 years, and we need to ensure over this year that the Udon project is executed correctly. We have a lot of investments that we've undertaken last year and will be undertaking over the course of this year as well to keep enhancing our welding consumables product mix, to ensure a richer product mix into various markets. New geographies for Ador International. There's 3 or 4 critical markets that remain that are doing well, that we'll keep focusing on, and we're adding 2 or 3 new geographies over the course of this year where we already entered them. And the automation division, which had a decent revenue growth last year but did not have a good bottom line. The main plan is to be able to turn around that to a profitable stage. These are the main focus areas for next year. The merger, we were actually, to be honest, expecting it in the last meeting, the NCLT, unfortunately, did not happen, and we are very, very hopeful that in the next upcoming meeting of the NCLT, this will hopefully happen, which is quite soon, which is why both Ador Welding and Ador Fontech have announced interim dividends to ensure that the dividend process is very clean cut prior to any merger being done. That's just a quick run through. I'll now request to handle the question and answers. You can pull off the shared presentation. So open up the screens. And we leave it open to anyone. Yeah, stop sharing.
Good evening, everyone. I'm your moderator for today's Q&A session. Our first speaker for today is Mr. Pritesh. Mr. Pritesh, you are now being placed in the meeting. Please proceed to ask your questions.
Yeah, hi. Just an observation. Why is the H2 number in performance, slightly weaker in growth rate? Where if you look at some other industries in, whether it's a consuming industry or capital good industry, the growth has been fairly strong there. So any specific reason with us or with our industry where the growth in H2 is relatively weak? That's first question.
Yeah, okay.
My second question is in the consumables business, what?
We lost you, Pritesh, we lost you. You hear us? We lost you after that. You said in the consumables business, now we can't hear you.
Right. I was expecting, or we were expecting the execution to start. So what's the status on this?
Yes, we lost
150
you.
crore.
Yes, we lost you. Pradesh, we lost you. After your introduction question, we lost you. Can you just go back? After that, you said something consumables.
Yeah. Volume growth in consumables. The third question on the flares business.
Yeah.
We had a 150 crore order which we got from ONGC.
Yeah.
What is the status of that order and the execution? Because some of it should have been flowing in 24, right?
Yes.
Okay, so over to you.
Okay, so HY2 growth has been fairly much in line with everything, but it's a big part is, of course, as you all know, that steel prices have been dipping down over from October, November onwards. Every month we've sort of seen it sort of trending downwards. And now we're seeing it moving back up. In fact, starting from April, we started seeing it moving a little bit upwards again. As far as volume growth goes, it's been pretty much exactly in line with what the market expectation is. We've been seeing it in the region of 10, 11, 12% on the consumables front. So we're quite okay with that front on the volume perspective. On the consumables, we're not too worried. The product mix is something that we keep looking at getting richer, and that's going okay. We've been helped also by the international market sales on the consumables, which is also picking up. But in general, it seems to be quite okay. We're not too concerned about it from the perspective of volume at the moment. On the flares front, we are running a bit late. We were expecting to see a much larger quantum of billing to start from December, Jan, to be honest, which is got pushed back due to a few engineering and execution issues. We're working very closely with ONGC on that front, and we are expecting that from May, June, that entire ticker will start moving a lot more aggressively. So yes, what should have been approximately another 30 to 35 crores of revenue that should have come in last year has got pushed in and will start ticking from now.
So any reason why there is a loss in the flares? The swing in numbers in your third division is significant this year. It's a close to 5-6 crore swing. So any reason why it's happening?
Any reason? Sorry, say that again. I lost you. Sorry. Say that again.
I think the swing.
Why there is a loss in the flare division?
Yeah.
There is. It's simple. I think there are two parts to it. The first part is that the cost. There is a slight cost overrun that is also happening. So the gross margin is slightly coming down in that order, which we are accounting for as well. Secondly, we've adopted a very conservative accounting method for this entire order. So we've taken a lot of the costs up front in that perspective. We've intentionally been very, very conservative on that account. Like I said, I wanted to be very conservative on that order. So we've done it accordingly like that. So that's basically it. And obviously, because your revenue has been low, the high overheads that you have in the division obviously have not been amortized over the course of last year. So that basically adds up to that.
Okay. Just last, what will be the flares business revenue next year, considering this ONGC project execution as well?
It should be anywhere in the region of 2.5 to 3x of what it was this year. Looking at somewhere in the region of approximately, say 90 to 100 is what we've as of now working on.
And at what margin?
Fairly similar margin to what you had expected earlier, with a slight dip. I'll say a slight dip because there are a few small cost overruns and stuff like that need to be looked at.
Okay. Thank you and all the best to you.
Thank you.
Our next speaker for the day is Mr. Ankit Gupta. Mr. Gupta, you are now being placed in the meeting.
Yeah, thanks for the opportunity. I have three questions each on the three segments that we have. So starting from the consumable segment. So if you look at it, we have registered a growth of around 10% in our revenues throughout the year. As you were saying, the volume growth also has been in line with the revenue growth last year. So when all your the major industry that you cater to, whether it is shipping, whether it is manufacturing, whether it is defense, all the sectors, the entire capex cycle is going through a very good time. Despite that, our performance on the growth front on the consumable has been relatively on the muted front. So, if you can talk about, why the end segments which we serve to are doing exceptionally well, despite that our performance hasn't been that great.
On the consumables?
Yeah, this is particularly on the consumable front. Yeah.
Well, I think on the consumables, I don't necessarily, as I mentioned, you have to keep in mind that the steel prices are very closely related to our product pricing. And if you look at the volume growth that we've kind of had last year, I wouldn't say it's been a good year. I wouldn't say it's been a bad year either. I'd say it's been a fairly average year from that perspective. And you have varying segments. You have segments that did well in Q1, Q2, and then segments starting to pick up now. But I think it's fairly on par with what we were expecting across the industry, basis the changes that are happening on consumables. I don't feel it's. I don't think it's exuberantly great. I would agree with you on that, but I don't feel it's below par as to what we are seeing with the rest of our peers.
So, but some of your customer industries or the consumer industry that we serve to have been doing exceptionally well. So, do you think our growth rate for next year should pick up from what we have done last year? And
I think it should pick up. I would agree with you. Yes, it should. I would agree with you. It should pick up. But I think if I have to look at the welding industry per se, I think whatever data we get and whatever market studies we run, we are pretty much in line with the volume growth that the industry is having. I would agree
Sure.
with you, like I said, I would agree with you that you've not outgrown the market. I would completely agree with you on that. And that remains something that we have to keep focusing on.
Sure. My second question was on the equipment front. We have seen a very good growth on the equipment front on the revenue side, but our margins have been pretty subdued, and they have reduced quarter on quarter for the past 4 quarters. And we earlier we used to talk that when we used to hold phone calls 2-3 years back, that are when this business scales up to, let's say, 150 crore plus kind of top line, our margins in this business should at least match the consumable margins. But last year we saw very good growth, but margins have in fact come down significantly compared to last year. There was no benefit of operating leverage, and earlier there used to be some challenges on the supply chain front, but I think those have been
Yeah, we've
rectified.
got most of those kind of sorted out slightly better. Yeah, you're right. So we had two issues that I think primarily helped, that then did not help, but we know what we're working towards. First is, I would say, the product mix issue, and that played a role. We had a slightly, I would say, not as rich a product mix as we would have liked, and that has a lot to do with the demand from oil and gas and pipelines and stuff like that. That leads to a little more. In fact, whatever forecast we're seeing should be fairly a little bit better than it was last year, a little bit better than it was last year on that front. That's number one. Number two, like I said, on our welding and cutting automation, which is part of our welding equipment, it all comes under the same thing. We, in fact, increased, our loss went up over there. Even though our sale went up, our loss went up on account of some orders that were poorly executed. We are in the midst of that turnaround happening, and you will definitely see a lot of benefit to that over the next 12 months. You can look at margins going up for sure if we can, as long as we hit these metrics correctly. I don't think they'll be at the consumables level yet, but I definitely think there's a lot of scope for improvement. You're very right about it. Definitely.
Will it be possible to reach double-digit kind of margins in the equipment business next year?
Next 1 year, it'll be a bit of a push, but we can get close to it. We can get close.
Sure, sure. My third question was on the flare side. We had incurred a big loss in the flare segments during 2018 to 2021 on our Middle East business, and then we had adopted a calibrated approach towards this segment. We had recruited some top management professionals from very good companies, and we were hoping that this segment will also report 10-11% kind of margins over the long run, and we will scale this business in a judicial manner. But as you were saying, there have been some cost overrun on the ONGC project. So how do you see this segment shaping out for us? And given the cost overrun in the ONGC projects, do you still think we can do 10-11% kind of EBITDA margins in the segment?
Yeah, I think it's a very important question, something I was expecting to get asked. Look, I think where we are right now is, just to keep our head down and execute this project correctly, as per our commitment and as per our trying to achieve the margins we had planned to. And I think at that time, which is in another 6-8 months from now, to reassess exactly the question you asked, whether this makes sense as a long-term play in a large capacity or not. But I think I'm not in a position to answer that question today. I definitely will not say yes or no either way. I just need a few more months to get this, execute this order and execute it to have that clarity. But you're very right. It's a very relevant question. It's been discussed at board level. It's been discussed at senior management level. It's not like we are adamant on any position. But right now, our thing is that we must correctly execute this order. But your question is very pertinent.
Sure. This last question on the Fontech front, last year has been flat for us on the Fontech front. So, how do you see this business shaping out for us for next year?
Look, the Fontech front is going to be driven by 2 or 3 things. It's going to be driven by what we have is our maintenance and repair product line, and then we have our maintenance and repair service line. The maintenance and the product line has a growth opportunity which is fairly in line with, like I would say, sort of an IIP type of number. You're not going to see it exponentially grow. Where you can see exponential growth come from is the services part, which we are starting to see better and better numbers coming from there, and a better order book pick up from there. I think you'll see a little bit of growth in line with welding's type of growth plan for next year, and the ability to push that a little more over another 2 years or so.
Sure. Thank you, and wish you all the best.
Thank you.
Our next speaker for the day is Mr. Dhwanil Desai. Mr. Desai, you are now being placed in the meeting.
Hi, good afternoon,
Hi.
Aditya and team. Aditya, a lot of the questions have been asked. Just one thing I wanted to understand. So what is the revenue from export this year? If you can spell out that number.
Still the balance sheet. Anyway, the revenue, I can give it this one. We managed to actually have a very good year on the export front. We managed to double the growth, double the number versus last year again. So I think we're close to approximately 120 crores of our welding business being export oriented.
So my question is that, if I look at the numbers, we have built up around 60 odd crores between last year and this year in terms of consumable. And I assume that a large part of our, export is consumable. So
that's actually not the right assumption. We have a very healthy product mix in the exports. It's actually 70% consumables, 30% equipment. Just to give you an idea.
Okay, but still the domestic part, is the volume growth domestic part is still lower than what we are indicating. Is that a right way to look at it?
The volume growth on the domestic part is, you're not wrong. It's pretty much in line with what we see the market growth rate happening in terms of the other. What we do a market assessment study and we get a sense of what is the volume growth that is happening in the industry is pretty much in line with that. I think what's important is, look, in the welding industry, you gotta understand the sectors you cater to, how it does. So if you look at our general infra sector that we cater to, heavy engineering sector we cater to, we're seeing good volume growth over there. If you see our auto, we are not seeing volume growth. If you see our railways, we had the first 6 months, 9 months, we had good volume growth happening over there. You have to look at it sector by sector. I know you guys would love to put in the brush. India is growing so well and every sector is growing so well and then growth should be so much. It's not, it's very sector oriented. So I actually am very happy with certain key sectors having done well and the overall revenue mix and product mix that we're moving towards. Especially if you want to keep pushing the margins up, which we are able to start doing decently in the consumables. So I have a slight, like I keep saying, it's not so simple an answer, but it's fairly okay. It's not great. It's not bad. It's somewhere. It's okay. It's okay. Last.
So no, the reason I'm asking all this is because I wanted to understand as a management, there were low hanging fruit in export. We have been talking about that. So you've been phenomenally well on that side. So when you set expectation for a year, 2, 3 years, do you set out expectations separately that, okay, domestically capex cycle is up, so this is how we want to grow and export, this is where we want to take it?
Yes, it is. Yes. It's completely separate. We deal with them very separate.
Got it. And second question is on equipment. I think we have done.
I want to add one point because you raised relevant points. I want to add one point because it pertains to you. Just keep in mind that Ador is very distributor facing in terms of its sale, right? So We have approximately 65% of our consumables, 70% of our consumables go through the distribution market, where there's a lot of stock in trade and stuff like that. That also happens besides our end user base. Just keep in mind that if you have the last 6 months where prices were moving a little bit downward rather than looking upward, you always have a more conservative stock position happening in the market. So that's something of a reality we have to also deal with a bit. But it's not a big deal. I'm just giving you an overview. It's not a big deal. It's manageable.
Sure. Second question on equipment. I think, we have done very well on the top line side of it. So if you can elaborate on what is driving such strong growth, and given that now we are at a base of a much larger 150 crores, how do you look at in terms of your growth aspirations from here on the equipment side?
Equipment seems to be. I think we're getting advantages on 2-3 fronts. One is the product. Vis-a-vis the imports, the gap is reduced a lot. I think the preference for domestic product is also there. I think our serviceability, all of that is there. We have select large customers who like working with us in bulk, which helps a lot. I think it's a question of us just being smart about cutting out the fat in the manufacturing, turning around the equipment, the automation part of it, and automatically we should see a big jump happening. I tend to think that the fundamentals are in place for another good year on that front. But we do have to improve our margins for sure. Yes, we do.
Last question. I think in your focus areas, you talked about 2 things. One is plasma, and second is better product mix on the consumable side. If you can talk a bit about, contribution currently, where do you want to take it, impact on gross margins, why are we doing all these things, and why those are the focus areas, if you can talk a bit about that.
So I can't really correlate it back, Ronald. I can't correlate it back into a margin over here. But what I can tell you is that, look, at the end of the year, the net margin that we've ended up with has been, even if you remove the flare impact, the net margin has scope for further improvement. That scope for further improvement will not come purely by large volume only. It will come by more specialized metals in the consumer space, higher grade steels that we work on, stuff like that. So that is where that will end up coming from. And on the plasma cutting front and stuff, there's a lot of scope of just you're moving into higher end applications, all of that. So that's where we want to keep moving towards that, getting the brand to have more upper tier significance and all of that, and a larger per unit price on many different orders. So that's where we're trying to move it towards, and I think that will definitely help us as well.
So just a follow-up. So do we have that capability in-house, or are we building it, or
some parts are a mix. It's a mix. Some parts are in-house. We have a large technical development center, but the truth is also that there are times we lean on for foreign collaborations and stuff like that. So it's a mix.
Okay, thank you. That's it from my side. All the best.
Thank you.
Our next speaker for the day is Mr. Nasar Parekh. Mr. Parekh, you are now being placed in the meeting.
Yeah, hi, Anand. Thanks for taking the question. First is on volume growth you mentioned. Can you give Q4 volume growth in consumables for us?
Compared to Q4 of last year, we had approximately 1 or 2% volume growth quarter on quarter for Q4. Yeah. And versus the previous Q3, we were plus 14% growth.
So on Q4, that's the question, right? 2% volume growth is the industry in Q4 just growing at 2%? Or are we losing market share?
So as per my assessment, I've been quite clear on the fact that I don't think we're losing market share. I'm quite clear on that front. That I don't think we are at the moment, unless I happen to see another 3, 4, 5 months of something that doesn't take, and then maybe we are losing a bit. But as of now, whatever we are gauging and we are assessing, we are not losing market share. I think you have to keep in mind the points I'm talking about when you talk about price correction happening and the industries that they're working on. And I think keeping all of that in mind, I think we are fairly stagnant at the moment. There is not a loss of market share. As of now, whatever I've seen, I would not tend to believe so.
So maybe not in organized markets, but then are we seeing unorganized players kind of get more, or is there anything of that? Because the underlying industries, I think a couple of people asked that question, where underlying industry is so strong, it's very difficult to believe that or not understand how 2% is the end market growth, right? So.
Yeah, I understand where you're coming from on that front, but I think if you look at it on the overall year basis, you're still looking at approximately 10% volume growth or 10-11% volume growth. So you have to keep slightly longer segment in mind on that front. Like I can't, I have to give a slightly longer window to study that data, and that's where it is. I think you have sectors like auto and all, which are, they're not as exuberant in certain fronts that you would think that maybe in terms of volume that is happening. So it depends where we play in those segments and stuff like that. But in general, yeah, as of now, I feel fairly confident that we're in line. But in 3 months, if I see something different, then maybe I'll have to reassess that. As of now, I feel we're in line.
Got it. Last time you had spoken about automation and automatic, autonomous vending and all that. So in that, are we making any progress, and what percentage today would be either in equipments or consumables would be the automation part?
Automation is still tiny for us. It's anywhere in the region of approximately 12-13% of our equipment revenue, but the contribution to the loss is quite significant on that front. We expect it to jump to anywhere this year at least to 20% of our, sorry, let me get my math right. It'll be approximately 25-30% of our revenue for this year on our welding equipment front, and it should be in a position to positively contribute at a good net margin, better than the equipment line if we do it correctly.
Got it. Does it only mean newer equipments that we are launching, or?
No, it's a lot to do with integration. It's a lot to do with integration. Basically, when you do for any automation of a line, so basically you're picking up your welding or cutting, and then you're integrating it and providing a solution from that perspective.
Okay, got it. And lastly, on the BIS case,
there's no movement. There's no movement. The stay at High Court remains, which is good, which is fair, and it remains on that front. There's absolutely no traction legally either which way of that.
Okay, and if I can just squeeze in one, just last year, when we look at our fixed assets, our gross blocks obviously very high. If we compare it to some of our peers. So one, is there, what kind of utilization we are at, and from a capex perspective, is it fair to assume we don't need to do any more capex for the next couple of years?
No. So capex, we've done a fair amount of capex last year. We have a little bit of capex, not a little bit. We have, I would say, 70% of the capex plan we did last year. We will have this year as well. We do have new lines, refurbishment, all of that taking place, new product lines getting entered in. You have to change a few old lines, all of that. I think you have to keep in mind that look, you're a legacy company that's sitting on a few gross blocks like that. That's perhaps why it seems like that. But no, it'll change. You'll see. But at least another 18 months of capex will remain there.
But more thing, if you are comparing with our peers, they are having the 30-40% trading turnover. In our case, it's mostly
it's very different in that regard.
They don't have their facilities.
Okay, got it. Thank you so much.
Thank you.
Our next speaker for today is Mr. Viraj Mehta. Mr. Mehta, you are now being placed in the meeting.
Yeah, hi. Thank you, Aditya. Aditya, my first question is on the flares division. We basically, when we took up this project in a couple of public interactions that you mentioned that the margins in this should be at, high single digit or low double digit kind of level for us. Now, my question is that if we actually include 8 crore loss that we have done because we have done losses, we have incurred cost for this year, then shouldn't the margins next year should be temporarily much higher, then only at a project level over a 2-year period, it will make sense of 10% margin, right?
Yeah, you're right. Well, like I said, firstly, we're running late on this project, and secondly, we have a few cost overruns on this project. So we